the house market is going to crater. And so they're
crater by, like, what do you mean by crater? Like 50% down, 40% down, 70%? 90.
So this is going to be horrendous. These pension funds are drastically underfunded in the first place. And what they do have is not necessarily something that's going to hold any value. And the returns that are baked into the equations are wildly unrealistic. So pensions are toast, unfortunately.
Hello, this is Aaron Wissner with Local Future, and I'm here on the line with Nicole Foss. Nicole is in New Zealand. Nicole, how are you doing today?
I am doing well, thank you. It's nice and early in the morning with a new day.
Nicole, can you tell the viewers, like, what is your background? What is your interest in all of this stuff going on?
How long do you have?
Short, like short. A couple sentences.
Well, so I run a website at the moment called Applied Systems Thinking, which is at fossblog.com. I haven't written a great deal for a while, but that's where all my work is collected. So my background is really interdisciplinary. It's biology, it's law, it's energy, it's finance, environmental consultancy, a whole range of different things. And so what I do now is pull it all together. So of all the different fields that I've been working in, I pick out the important points to draw everything together into the biggest possible big picture. And that's what I've been trying to do for probably 35 years, something like that.
I want to jump back to a thought that you said earlier, because I'm not sure that I agree, and I'd like to hear your perspective. So you said that if people are in debt, that they should focus on getting out of debt. But Steve Keen and others are going for this debt holiday or a debt jubilee, or you know, people during the 2008 crash, they lost their houses, but then they all have houses again. So I don't know that it's as, I mean, I don't understand, I guess. I'm asking you. Help me understand why, say half of your house not being paid off, why is that better to pay down that debt than going out and getting a bunch of seeds to grow gardens and making your community garden and putting up some food, you know, some staples, whatever staples that you can put up. It doesn't
There's a difference. There's a difference between paying down debt and getting out of debt. So what I'm saying is, if you possibly can, get out of debt. So if you have a mortgage, say your house, you have the capacity to pay down the mortgage of your house, but you've still got a 50% mortgage on it, or you manage to pay it down to 25%. Well, actually, banks are more likely to call in loans with low mortgages than high ones, because they have a better chance of being able to get some value out when they repossess your house. So it's not necessarily good enough to pay the mortgage down. What I would suggest is pay it off if you possibly can, even if that means selling the house and renting, which is exactly what we just did, by the way. So my partner had a house. We sold that because there was no way in the world we could pay off that mortgage, and we are now renting. So we no longer have any debt. We had debt before that we wouldn't have had any way to deal with. So we sold the house and got out of debt. And that has made an enormous difference. We're now in a vastly better position than we were before. And I mean, renting here isn't.
So what I'm hearing is, if someone had recently bought their house and, like, they had borrowed, so to speak, 90% of the value of the house, or 95% or 99% or whatever, and they still had that whole 30, 40, 50 years, then for them, obviously this isn't a possibility. So the importance for them of paying their mortgages is relatively less than for someone who is within striking distance of paying it off.
Yeah, so if you have a huge mortgage and you're in negative equity, then banks are not necessarily going to be in rush to foreclose on you and resell the house. I mean, you'll end up with price discovery if you do that as a bank, and you won't get very much, because how are you going to recover the debt if the debt is larger than the value of the house?
For anybody that's not sure, what do you mean by price discovery, and why is that bad for banks?
So price discovery is when you sell something, when two people make a bargain on an asset, then that sets the price for that asset. So in terms of housing, you know, when you sell, when there are comparable properties that are sold, that will set the value for the whole neighborhood. So this works on the way up and the way down. I mean, you get prices being bid up and up and up. And when there's one house on your street that suddenly goes for, say, $50,000 more than it did the last time, everybody's house on that street is now worth more. And the same thing happens on the way down. If one of your neighbors suddenly sells their house for $50,000 less than the prevailing area was worth, the prevailing area is now worth what that house sold for. So you see these things happen all the time. And when you actually have a huge amount of downward pressure on prices, then as soon as you encourage sales at those prices, you have repriced the entire asset class. And the bank's viability rests on the value of the mortgages that they've granted. So if the property prices crash, and it's obvious that they've crashed, then those banks, what the loans that they've made are going to be worthless. And those loans are somebody else's supposed asset. So you get in a huge amount of trouble when you start to ratchet down, especially when real estate is such a huge part of an economy. So when you have people who've been flipping houses, and you have all the renovations industry and the furnishings industry and everything else that you have absolutely booming for a while, and then the house prices start to drop, you can lose 15 to 20% of your GDP. So if the market just goes illiquid and people stop buying and selling at all, then you don't have price discovery. So people can still tell themselves that the houses are worth what they used to be, or they might even be able to tell themselves it's worth more because houses only ever go up, so they can assume that the thing is still going up even although the market is illiquid.
But this has to be inevitable though, right? Because
yes,
there's going to be somebody like right now in Michigan or New Zealand or whoever who has to get out of their house because
yes,
either the grandparents have died and they want to sell it, or they've divorced and they want to sell it, or they have to move. There's going to be people that are forced to sell and put it on the market, yes, and they're going to be forced to bring the price down until they get a sale, right? So it's inevitable that this happens in this sort of situation where we're in right now.
Yes, it's absolutely inevitable. And it would have been inevitable even without the virus once the bubble burst. The normal way housing bubbles burst is the market goes illiquid, then some people are forced to sell, as you were saying, for a lower price. Then the prices ratchet down, and people say, oh good, prices are falling, I'll just wait. And then the market goes illiquid again. Someone else has to sell for an even lower price, and you just ratchet down over many years. But with the virus, this seems to be accelerating the timescales for the bursting of a bubble. Bubbles can burst really quickly anyway, not so much housing bubbles, but bubbles in financial assets, because financial assets are virtual. Those can reprice extremely quickly. But normally physical assets don't do that quite so quickly. But because this virus seems to be accelerating the timescale of the bursting of a bubble, there's just no time to adapt. And this is going to be a huge problem, because if you don't have really any time whatsoever to adapt, you get stuck in all these situations where you have to make really perverse sort of decisions, like paying someone to take oil off your hands or things like that.
So Nicole, I want to stop you there for a second, because maybe it's the wrong thing to do. Back during all these scientific discoveries, and then suddenly we find out that the science can be used for weaponry or making a nuclear bomb or whatever. Maybe this is information that people shouldn't know, because suppose I put this on the internet, and suppose 10 or 20 people watch it and they realize, oh, they should put their house on the market right now. And then there's the herd mentality, which is, oh, we also should put the house on the market. And maybe it just becomes a meme, right? So it's not even they see this video or anything. It's just that now's the time to sell. It's the time to sell is right now. Even if you can't go.
That's exactly what people are going to try and do, but it's too late. That's the problem. So people aren't necessarily going to be able to get rid of a mortgage, because with all these lockdowns and people not moving around and people hanging on to their money for a rainy day because they've lost their job, the house market is going to crater. And so they're
crater by, like, what do you mean by crater? Like 50% down, 40% down, 70%? 90. So you're saying, so I looked on Zillow or Trulia or whatever we have in the US, and this house was close to 300,000, which was much higher than we purchased it for. We purchased it for $123,097, and now it says, oh, you can sell it for 300,000. That doesn't even take into account the improvements we've made.
Mhm.
So you're saying $30,000.
Yes, I mean, not immediately. It will still take time to go down that far. So you might get the first set of falls, it might go down 30, 40% quickly. But where I would suggest for some kind of lasting bottom or semi-lasting bottom is about 90% down on average. And this is true for most bubbles. That's where things go. So what you end up with, you have to go back to before the bubble began. There's always an undershoot. So if you look to before the bubble began, the prices will go up and then they crash to an undershoot and then they may go up again or they may stay flat. But the undershoot takes you back to where before the bubble began. And the bubble began.
Back in 2008, though, the prices went down in the U.S. only like
They
by
hadn't
about
completely
50,
burst.
only like 50%.
Yes, but that wasn't the final bursting of a bubble. That was a correction in an upward trend. So things hadn't actually topped out at that point. There was the same thing happened in England in the late 80s, early 90s. Prices fell about 30%, and then they went to ridiculous highs. So that wasn't the final bursting of the bubble. But when this is very likely to be the final bursting of this bubble. And so what ends up happening is you will go back to before the bubble started. So you're looking at the asset prices of the 1970s. So what would your house have been worth in 75, for instance?
Well, I have no idea. The house wasn't
If it was
built
even built,
then.
but
Yeah.
I don't remember whether your house would
And this is before, isn't this before the world? I mean, the world was on a commodity standard until like 1972 or something, and then Nixon separated the U.S. dollar from the gold. And
Yep.
Doesn't that make a difference? I mean, I don't know. I don't know.
Well, I mean, really, what separating the gold from the dollar and things, which is what Nixon did. I mean, this really set off this enormous credit bubble. That's where you had this enormous magnification of credit and debt. And it started off properly, I mean, as just a proper economic boom, because initially in a boom, you have self-liquidating debt. So people start to become confident enough to start businesses again. So they borrow money to invest in a business. They set up a productive asset that produces an income stream to pay down the debt. So self-liquidating debt is not a problem. That's the way economies normally work. When you have credit to sort of lubricate the economy, all sorts of things are possible, and that's not necessarily a bad thing. Over time, we started investing our money in just anything, consumption. So, I think I'll just take a trip around the world or something like that, or I'll buy an enormous SUV because I'm compensating for something or whatever it may be. But then you haven't generated an income stream when you do that. You've burdened other income streams. And then later on, it gets even worse, where people start going wholesale for speculation. So it's just pure gambling at that point. So they're taking borrowed money and they're gambling with it, putting it into the market, saying, well, these things
Nicole,
go up.
It's surely not gambling. It's not like me going to the casino that's the native tribe owns 10 miles from now. It's not really the same as that, is it?
Well, it depends. For the housing market, no. But for the stock market and things like that, for financial assets, yes, it is exactly that.
It can't be because Nicole, people have 401ks and pensions in the stock market. It can't be the same as a casino. It can't.
Well, those people mostly don't control the assets that they have, and what they do control is such a tiny percentage of everything. Most of what's happening is big players with these fast algorithms and things trading all the time. It's all about bets on price movements of underlying assets. It's very, very divorced from anything that's real. So this is really the problem. This is why you have excess claims to underlying real wealth, because you have all these contracts that you can sell, say in the derivatives market. The derivatives market has no connection with actual underlying real wealth. It's just, I think this asset is going to do this. You think it's going to do that. One of us will pay the other, and if it goes in the direction that they believed it would go in. This is absolutely a casino. And it's a $250 billion casino in the derivatives market, approximately. I mean, nobody knows for sure, but of that order. So much of this is gambling. And if you look at pension funds are often managed they're not managed by the people who own them, typically. They're managed by somebody else. And There was a whole lot in 2008. I was writing about pension funds being sold the worst kind of toxic assets because they were chasing yield without realizing they were chasing risk.
Right. Well,
And so,
in Michigan, it is the law that
mm,
our fund manager in Michigan for the pension fund for all the state employees, the former state employees, the retirees, well, and the ones who are still contributing, so to speak, 8%. That's what the state legislator said. 8%. We want you to get 8% every year.
they'll be lucky to get -8. That would be -8 would be a huge bonus. Those pensions don't exist anymore. Other than on paper, they're gone. So the financial industry, when they were selling toxic assets to pensions, they called it landfilling toxic waste. So they knew perfectly well that they were selling pension funds assets that would be worthless. And the same thing is happening again. Pension funds are chasing yield, but when you chase yield, you chase risk. And people say, but I need this kind of return. But what they're doing is they're going to lose the income and the capital. So this is going to be horrendous. These pension funds are drastically underfunded in the first place. And what they do have is not necessarily something that's going to hold any value. And the returns that are baked into the equations are wildly unrealistic. So pensions are toast, unfortunately. And this is absolutely part of the bubble.
Okay,
And this
Nicole,
comes as a shock to people.
I get a pension check of about 2,000 US every month. So how long until that check stops coming, Nicole?
I can't tell you how long until it stops coming, but it's going to stop coming. And so this is going to be a major, major problem for a lot of people. So this is a financial perfect storm. When you move into deflation, what you get is unemployment goes through the roof. Interest rates, which are currently really low, are going to go up. At some point, they're going to spike very, very much higher. People are going to find their negative equity, they lose their homes. The market crashes, they lose their investments. You know, they're losing other sources of income as well, quite likely. And they just get really caught. When unemployment is high, for instance, there's no bargaining power for people who are employed. If there are 100 people who would happily do your job tomorrow for half what you're being paid, then you're going to get a 50% pay cut.
If you are seeing this on YouTube, if we do decide to post it, then please hit the like and the bell and the subscribe and leave a comment and the comments and questions, because who knows, maybe we will put this online. Maybe people will have questions. Maybe we'll Nicole and I will chat again.
I'm happy to do Q&A and stuff like that. I have no problem with that. In fact, if you want to tell people that they can submit questions and then we can do a session where we answer people's questions, I'm happy to do that.
Yeah, that would be fun.
Interactive stuff is great because it draws more people in.
All right.
I think that would be useful.
I'm going to sleep on it.
Okay.
All right. Thank you so much, Nicole.
You're welcome.
Take care.
Bye.